Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Stay in the TMT space, if you will. We're going to talk about check in with Anurag Rana. He's a Bloomberg senior tech analyst for Bloomberg Intelligence. Anurag, you know Microsoft as well as anybody. Put into context for us this cybersecurity attack. It's been certainly at the top of the news here this morning, and it just kind of, I think, at least to me, is surprising that a company with the resources and the technology expertise of Microsoft, that they could, in fact, still be subject to this type of risk. How should we think about it?
Yeah, Paul, when it comes to almost all the major tech companies, this is probably the most important and, biggest risk for them. And again, whether it's Microsoft or Amazon or Google, this is one of the biggest worries for all of us is, you wake up one morning and you see a big outage out there. I mean, almost a year ago, we remember that CrowdStrike problem and what it did to, airports and all the other things. Now, but in this particular case, I think it's a lot less problematic than what we saw a year ago. This is primarily based on certain on-premise software. I mean, there is an on-premise version of SharePoint software that they have. It's only affecting those particular workloads, so it's not as widespread as some of the other areas we have seen.
Now, what does this mean for cybersecurity companies?
I mean, it's a good thing for them. They are, to be honest, over the last 15 years that I can remember, they're probably the one area. It doesn't matter what the macro environment is. They continue to grow, bigger and bigger. That's because there's so many little nuances that have to be protected. These networks have multiple software from multiple vendors. And a lot of these companies do some unique things, go prevent them, endpoint security, analytics, you name it. I mean, there is no shortage of, I would say, funding for a lot of those companies.
So how do you characterize, or how do investors characterize just cybercrime risk for some of the big tech names that, the Mag 7 names, or just the big tech names in general? It's something that we don't really talk about too often, do we?
No, and in fact, as I said, I've always said that this is probably the biggest risk that faces all of us. Because remember, think about it, like AWS takes care of a lot of startups right now. You see a problem with that network, the rest of them goes down. Same thing you could say with Google's cloud platform, Microsoft's cloud platform. This particular incident is only for the on-premise application. So, in a roundabout way, maybe this helps Microsoft in the long run, that those customers say, you know what, I need to move online. I need to move more workloads to the cloud. But in totality, you look at it from a cyber insurance point of view, insurance companies don't even want to go down that route. This is one of the biggest hidden risks for all of us, especially as most of our savings are, digital and, placed in not in, safe boxes, but in investments somewhere digitally.
And Anurag, in the tech space, we also had some IPO news. You had Figma looking to raise about $1 billion U.S. IPO. What is Figma? What do they do? What's their market value?
Yeah, I was, this is probably one of the more interesting companies that I have come across in a long while. A few years ago, Adobe made a run for them, paid $20 billion to buy them. That deal didn't go through. Adobe ended up paying Figma $1 billion as for a breakup fee, but now they're going public. It's a very unique software in their market. What they do, nobody else does it so well. They help you design application all the way from ideation to, publishing applications, or you could say issuing applications out there for people. So, we want a whiteboard, you want to discuss this idea with the team. Phenomenal software. It has very high market share. And at this point, to be honest, Adobe had one product that had some overlap with them. But frankly speaking, there isn't a large company out there that's a credible competitor for them. So we think this is going to be an area where see strong interest. We anticipate sales growth north of 40%, both for this year and next year. We think revenue could be $1.6 billion by the end of next year. And, our analysis indicates a post-deal valuation somewhere between, $19 and $23 billion, or $21 billion at the midpoint.
And this proposed stock symbol for this pending IPO is FIG. Bankers are Morgan Stanley, Goldman Sachs, Allen & Company, and JP Morgan. So the blue chippers there for that deal. And Anurag, in your software space, we've had a couple of pretty good deals this year. Circle Internet Group, CoreWeave. Do you expect more?
I think if you have the capacity to go out in this market and raise capital, this is really good. Valuations are very nice right now. I mean, I would strongly encourage if there is somebody who's looking at it. But at the same time, there is an issue about, do you want to go and see your work being scrutinized? Public funding is also very good. There is so much private capital out there. So it really depends on what somebody is doing. Last year, we saw an IPO came out, Service Titan, and just in the first 2 months or first 2 quarters of their coming out as an IPO, they actually saw demand go because people recognize what this company is. I think the same could happen to Figma when, a lot of people don't know what these guys do. And, that recognizes the value of the software or the company just by going public.
All right, very good. Anurag Rana, Senior Technology Analyst, Bloomberg Intelligence. He's in our Chicago bureau. We're talking about a little bit about Microsoft. They got the cyber security issue that it is dealing with. Plus, we got some IPOs in the software space picking back up. It's always a good sign here.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, well, earlier this morning, Verizon CEO Hans Vestberg, he talked to Bloomberg Sonali Basak about some of the things that the company is doing right now. They just had their earnings report, but now we want to get the analyst view on that. So for that, we'll bring in John Butler. He's Bloomberg Intelligence Senior Telecom Analyst on these Verizon earnings. So, John, good beat, second quarter revenue, raised the profit outlook. What's making the company so optimistic?
So I would characterize, when I look at Verizon, I think of the phrase game of inches, right? I think the improvements here quarter in and quarter out are incrementally better. They're edging towards that acquisition of Frontier, which is really going to change the game for them. But in the meantime, they put a lot of changes in place in terms of their go-to-market strategy, how they're combating promotions coming from T-Mobile and AT&T. And on the margin, quarter in and quarter out, I just see them doing a better and better job. I think all the actions they've taken are starting to work. And so taking the long view here, I really think Verizon is improving just quarter in and quarter out. And this was another quarter where you could look at it in isolation and say, it was a solid quarter, a little bit mixed on some of the metrics, but I think on balance, better than last quarter and last year.
John, what's kind of the positioning of Verizon in the marketplace? Like, I've been a longtime Verizon wireless customer since the beginning of cellular service, actually. And I guess I was initially drawn to it because I thought they had the best network, so quality. Is that still the case? Because it seems like, I don't know, T-Mobile's gotten a lot better in quality and AT&T, I don't know.
Yeah, Paul, you bring up a good point. I think there's a question mark out there as to whether Verizon still has the best network versus T-Mobile and AT&T. But I think they have a slight edge there in terms of coverage. And it's interesting. A lot of people ask me about wireless, who has the best network, who should I choose? And the one thing that people are always asked about is how's their coverage? I think coverage is very important to people. And I think when you think on that metric, in terms of that metric, Verizon delivers the bars on your smartphone probably more than T-Mobile and AT&T. In terms of download speeds, though, I suspect that T-Mobile probably is gaining the edge here.
Now, what about prices? Did Verizon increase their prices? If so, did that help?
So we did see all the carriers are increasing prices right now as the market matures and new user growth is slowing considerably. The only way you're going to grow that important service revenue metric is by raising prices. They tend to do it on older plans. Verizon's done it over the past 6 months, as if you look over the past year or so as AT&T and T-Mobile. That's flowing through and it's helping to boost the service revenue. I think over time they're adding in those little extras like device insurance and perks like, added content that you can purchase at a discount through Verizon. And I think all that together is going to continue to provide a lift to service revenue. It's nothing special. Again, I'm looking forward to that Frontier acquisition where they're going to buy, access to 2 million fiber broadband subscribers and 8 million fiber homes passed, because once they get Frontier under the hood, they're going to be able to bundle their wireless service with fiber. And I think that's going to help to really drive renewed subscriber growth.
So, John, use of cash here, how do they kind of allocate it between debt reduction? They've got a lot of debt on their balance sheet versus funding that big, juicy 6% plus dividend yield.
So they're doing both, Paul. I think free cash flow is going to get a lift from HR1, the new tax legislation. It's also a very cash flow rich business. As we exit the year this year, they'll have most of their cell sites upgraded with the new C-band, mid-band spectrum, which again is improving network speeds and enhancing their coverage. So that whole project is going to begin to wind down a bit as we get to year end. So they'll be able to sort of maintain spending without having to increase it, which is constructive to free cash flow growth.
All right, John, thanks so much. We appreciate it. As always, John Butler, Senior Telecom Analyst for Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's go back to the car business. And we talk about a name we don't talk, I don't think, enough about, or as much as maybe we could, and that is Stellantis. I think about the old Chrysler with Fiat and all that kind of stuff. I'm not sure what all the brands are there, but they took a $2.7 billion charge here. Steve Mann, our global autos and industrials research analyst for Bloomberg Intelligence, he joins us here. Steve, what's going on with our friends at Stellantis?
Yeah, so they reported the preliminary first half numbers today. They booked a loss and a charge of $3.3 billion. A lot of that is, canceling the fuel cell R&D business. They're canceling like an EV for Maserati, taking some other charges on recalls and tariffs. Overall, at the end of the day, I think if you listen to the call, there's really no new bad news, which is good news for the company. I don't think it can get any worse. So and that's why the stock's actually reacting positively at the moment.
Steve, what about the president's efforts to dial back the support for EVs? Is that affecting them as well?
They are revisiting the EV business, not dialing back, not so much in Europe, but revisiting it. Definitely in North America. And one thing that it's really bad for the quarter for them was really their North American business. Their North American business drives most of the profit. Shipments were down 25% in the first half, year on year. And a lot of that is controllable. A couple of things that they are doing to kind of arrest that decline is not only cutting back on production, but they're relaunching a couple of popular models that they've discontinued. One of them is the Jeep Cherokee. It's going to come back later this year. And more importantly, to stop market share loss on their Ram trucks is they're going to reintroduce the V8. So, they delayed, they didn't really say cancel, but they delayed the EV product for the Ram trucks, but now reintroducing the V8, which is, the biggest engines you can get for a gasoline engine you can get on a truck.
So where is Stellantis in the world of big auto? How do they position themselves? I think about Ford, GM, Volkswagen, the Chinese players. I'm just not sure where to put Stellantis these days.
Yeah, I think, they do have an important role to play in the auto market. They're really strong in Europe, particularly in their, what they call the B and C segment, which is the hatchback, the compact, subcompact segment. They also have really high market share in their commercial vehicle business. This is like their Ram Transit van that you see, a lot of contractors use. They have 30% market share in Europe. And then again, Ram truck is one of the most popular pickup trucks in the U.S. market. Unfortunately, Ford and GM has taken share from them because they didn't have the V8 when they, talked about EVs and more fuel efficient trucks. But the U.S. market is quite different. Commercial users do love the power, the torque, so they're reintroducing the V8 just to try to gain more market share back.
And they have a new CEO, Antonio Filosa. He's in office for roughly a month, so he's just getting there. What are some of the top items on his agenda? Has he talked about it?
No, but we'll hear more about it on July 29th. So today's call was just a preliminary call on first half. We're going to hear from the new CEO on the 29th, and I think a lot of the questions still in the air is, what is the strategic direction for the company in terms of EVs? How are they going to manage the tariffs, which is still a big unknown because negotiation is still ongoing with Europe. And then, what are they going to do with some of the kind of slower performing brands like Maserati, which is really draining a lot of their cash.
All right, Steve, thanks so much. Appreciate that. Global Autos research analyst for Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, Lisa Mateo, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. I consider myself a pizza aficionado. Ooh. So by definition, I'm not really a Domino's person because I live in a world where there's great local pizza. But for a lot of the world, that's not the case. And so they depend on the Domino's of the world. And they came out, and you saw that in the numbers today, some pretty good numbers. Let's break it down with Michael Halen, Senior Restaurant and Food Service Analyst for Bloomberg Intelligence. So some pretty good news out of Domino's. Mike, what'd you take away?
Yeah, listen, they have some nice tailwinds this year. Stuffed crust pizza has done really well. It's really driven some strong same-store sales here in the first half. The industry's about flat in the U.S. and they drove almost 3.5% comp here in the second quarter, so outperforming the market by a pretty significant margin. And they also rolled out DoorDash to all their stores in the second quarter, and so they're going to start ramping up the marketing there, and that should give a nice boost to the shares over the next 12 months or so, and maybe beyond. And so, yeah, for those two reasons, we expect them to continue to outpace their QSR pizza and QSR burger competitors throughout the year end.
What about their loyalty programs? I know a lot of analysts were saying, this is going to be a big boost for them. Did it help out?
Yeah, that was the other thing they cited, and so they rely heavily on households making $50,000-$60,000 a year and below, and so as everyone knows, that's been a very weak segment of the restaurant industry for the last few years due to all the inflation, right? And so to bring people back in, they started lowering the redemption, the number of points needed to make redemptions on the loyalty program, and it's been successfully bringing in more carry-out consumers, which are typically lower income, right? And so by bringing those consumers in, it's definitely given a boost to their traffic over the last 3 quarters or so.
So what's Domino's and some of the other restaurant chains that you cover, Mike, what are they saying about tariffs and how that might impact their costs, and how much of their costs will they take in margin versus pass along to consumers? Is there a consensus building?
It depends on the chain, but luckily restaurants source a large majority of their product in the country in which they're operating, right? So Domino's operates in over 80 markets, and all of their product, all of their countries largely source everything domestically, right? And so restaurants are in a good space. The restaurants companies, the stocks got hammered back in April. I think that was largely a case of the baby being thrown out with the bathwater, because restaurants have very low exposure to tariffs, and I think we've seen that in the rebound since April. Some of the restaurant names we cover, two ones that we like, Shake Shack and Cracker Barrel, they've rallied 100% over the last couple months. And I think they're in a good place because, if people do recognize some price increases at retail, at the mall, stuff like that, whatever it is, 15, 20%, they're not going to see those same increases in restaurants and may, look at it as a better value.
So people are still dining out as much as they used to? Because I know I consider myself thrifty, so I cook the entire week, and then we pick one night where we go out to eat. It's a Friday, because Mama don't cook on Fridays. So are more people? Do you see that kind of a change in the habits of the people who are going to eat out?
Well, we've seen that. No, there's no doubt, especially due to all the inflation. We've seen traffic decline now for several years in a row. But restaurants have been able to, the ones that are doing well have been able to more than offset that with price increases, right? And obviously the best performers of the bunch are absolutely able to drive traffic. And that's really about providing a very good experience. Right now people are very discerning about where they're going to spend their restaurant dollars. When they go out, they want to make sure they're not going to have a bad experience. And so they're continuing to go to places, think Texas Roadhouse is one that really stands out. They're going to a place where they know they can get good value on the plate for what they pay, a very consistent experience, right? And because of that, you're seeing a wider divergence between the winners and losers in the restaurant space.
Mike, how about labor? President Trump has effectively shut the southern border. Have your companies, who rely to some degree on that labor force, are they seeing it yet?
Yeah, everybody's logged on to E-Verify, and most of our chains, are making sure that their employees have papers and are operating legally. It's more of an impact to, I would say, the independent restaurants in the country. But then, what happens is that ends up being a price competition, and so it drives up prices for labor. And we're seeing another year of about 4 to 5% wage rate inflation in the restaurant industry this year.
And are we changing how people are changing how they eat, right? So in the last 30 seconds or so, GLP-1s, are restaurants cutting back on those portions, making things smaller, less on your plate?
Well, they are, but mainly because of inflation.
Oh, there you go.
GLP-1s, over time, we expect that to be the biggest way to combat that is to decrease the portion sizes and to make sure you have some healthy options on the menu.
Michael Halen, thanks. We always appreciate chatting with you, getting the lay of the land in the restaurant business. Again, Domino's put out some good numbers here today, so good for them. Michael Halen, senior restaurant and food service analyst for Bloomberg Intelligence. He's based down there in our Princeton office.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.